Business debt consolidation and or refinancing, and more options for business debt that you need to take care of, such as a reverse debt consolidation, a debt restructuring, and a few other things that we can go into certain scenarios on, plus 0% interest business credit cards for 6 to 18 plus months. And how does this factor in with debt consolidation and refinancing? There will be a flow to this, so stick with me until the very end of this video so you have the pro tips to understand how to navigate, how to have better cash flow, how to invest in better opportunities, current opportunities to increase your revenue, other streams of income, and a lot more. But before I get started, my name is Michael with Viral Funding Solutions. I'm a business funding expert, business loan broker expert, pre-underwriter / underwriter who's helped out a lot of people get the right type of funding under the right strategic partnership and roadmap for longer term success. I've been doing this for a long time, helping people consolidate their debt, refinance. There's a difference between the two of them. And then also doing a few other instances that I believe are even stronger, like where there's people going through and getting a 90% approval rate into a specific program and getting 40 to 75% plus on average of their debt restructured and lowered. And this is a great opportunity for many people, and I've helped out a lot of people with that recently and in the past, as well as I'll do more of that in the future. And many people love it because the goal to a lot of this with a lot of these, as you're seeing, is improving cash flow, having more working capital, having better positioning when you are moving forward and investing, especially in new opportunities for growth and expansion. You're scaling something existingly, you're getting new contracts for equipment, you want to restructure things, you're trying to sell things, your cash flow is all sucked up into inventory. There are many other places, and I help out a lot of people understand their own cash flow, profitability, EBITDA, and in many other areas. So I'm more than just an expert when it comes into funding, understanding should you go through a cash flow backed program, revenue income backed, collateral backed, credit backed, equity, liquidity, and other options. I do a lot of that every single day. And just before I get into the document here you see on the screen, we'll be going into exactly the layout of it and the details of it. I just want you to know, for full transparency, I'm that person who has your best interest at heart. I've been where you are. If you are a startup now, I know how difficult it is getting started, having the structuring of your business done correctly as you're navigating increasing revenue, making changes here and there, having lower overhead, understanding and mitigating your expenses. What are your highest expenses? What are your costs of goods sold? A lot of these other factors out there that a lot of the times you don't pay attention to in the beginning. You're not profiting enough. It's not where you want to be profitability wise now, but how do you improve for the future? How do you scale back if you had to? How do you improve your revenue in certain parts of your business? There are a lot of different areas. And I'm a Libra. I'm a very loyal person. I'm the introverted, cerebral, analytical type, meaning that I look at a lot of documents too. I'm very math system oriented. I went to school, I have a background. I played Division I soccer for a little bit, studied a little bit of sociology, then migrated, moved into chemical engineering, and I did that for a little bit. So I love chemistry. It's my favorite class, mathematics. And I had to make a big decision because I wanted to start a business. So it wasn't easy for me at the time, but I moved into the business side and I went thereafter. I didn't start my business right away. I have worked in construction, manufacturing. I worked in warehousing. I was a ramp agent in my younger 20s at one point. Can't believe I even did that. It was something just temporary. Not everything in life is linear. And I grew up with a supportive system, my family, my younger brother as well, my mom and my dad. And I've had a lot of experiences and going through the trenches when getting funding. I know how hard that can be, especially if your cash flow is tied up into like a lot of merchant cash advances or MCA like debt, hybrid cash advance term loans, other business debt. So I'll be getting into some of like the restructuring that I believe is very strong and what a lot of people are getting themselves into, especially if you are over leveraged in other areas. So with all of that said, I'm going to get into the document now. So let's begin here. And I have a few points. So I'm going to scroll down here. You will see business debt consolidation and refinance. I just pulled a few things from other documents that I've had and I've helped out people with, but this is just a very general overview and I'll get into it a little bit more. But business debt consolidation, let's start there. It's taking on a new loan to replace your existing debt and move everything into one. So think about getting like 3, 4 merchant cash advances, or you have an online bank term loan and or you have a line of credit or things like this, and you want to move it over to an SBA loan now. There are instances where, let's say, for example, you have 3 merchant cash advances. Okay, can we debt consolidate? That's the question. Can we lower our interest rates, have a better monthly or get into a monthly repayment? Because with those, they're normally daily or weekly, sometimes bi-weekly or monthly, but you rarely ever see those lenders. I have them. And just in case you're wondering if this is your first time too, I work with the best lenders out there by far. A lot of you may think, well, it didn't work with you, then you might go try something else. And I don't always bring it up, but for full transparency, sometimes I'll bring it up for you too, and to say, you can try to go apply somewhere else, but believe me or not, you'll get the same result, very likely. And if you didn't, somebody over there is over promising and under delivering, and you have to question the ethics, who the person is, not just looking at it from a business point of view, but who's the person you are working with. And so just know that I'm that person who's very loyal, who's very well balanced, emotionally controlled. I do what's in your best interest. I put myself in your shoes. I want you to improve more than just your wealth. I want you to be better in your health and your relationships, because I'm not a personal development guru, but as an entrepreneur, business owner who runs multiple businesses, I've learned how personal development is huge. So I pay close attention to other parts of my areas and how that affects me in my business processes. And if I didn't say this, which I didn't, I run a digital marketing agency lead generation business. I've done that for a while. I've outsourced bits of that, so I can focus on this as my primary way. I have a health affiliate marketing business, other verticals in the affiliate space. I did an e-commerce with my health business at a point until I went back. And then I got into other verticals, other ventures, and this has been my primary focus. And a lot of people love to work with me because I'm not conceited. I'm not cocky. I'm very confident and certain, and I don't let anything get to my head. I'm not materialistic. I'm very old school oriented, you could say that, in a millennial type of age. I'm not in my 20s anymore. Just recently, I'll give you that, I turned 30. So there's that when you're watching this. And so I give back to the community, and keep this in mind. I don't earn until you earn. I'm not charging you anything up front or out of pocket. I could put a consultation fee here, packaging into my program here for a course or for this. I have all that built, but I haven't put it into it. I want to be as authentic and as real as you get this material. And I want to be that person that's different. And you're going to see that when you work with me if you haven't. And if you have, you'll know that in my processes, my systems automation. And if you're trying to get in contact with any of this information, down below in the description, there will be a questionnaire form for you to fill out for any of this: consolidation, refinancing, reverse debt consolidation, debt restructuring, a few other instances, how we move up and down. And so that'll be down below. It'll change probably more or less how I have you submit that, but look down below, fill out those details. I'll analyze and evaluate it and give you a proper email response, even with the PDF displaying information that's not even publicly released for the most part, or some of it I put onto here or in other places. You'll get a better step-by-step process on how to do this correctly and what to submit. So here you see taking on a new loan, as I mentioned, to replace your existing debt and move everything into one. So it's a great option if you're trying to lower your interest rates. Like I just said, it could be a significant difference. It could be a minor difference. But what a lot of people end up doing when they consolidate is they want to move their type of payment structure. If you're already over leveraged in cash flow, average daily bank balances, starting in monthly bank balances, everything else that I calculate, because I do a lot of that. I do a lot of analysis on cash flow analysis from bank statements on a micro level, even lower than that. Everything else on the personal side, what we're talking about when we come to tax returns, P&L, balance sheets, SBA loans, online bank term loans. And there's a lot more that I calculate on my end, not just operational cash flow, investment, financial cash flow, but there's quite a variety of things that I'm looking at my depth chart and also seeing the industry you're in. But one thing is to pay down to lower your interest rates. That's a great option if you owe a lot of debt right now with other advances or other options, and you're trying to save in a significant amount and put everything underneath one loan payment, which would give you a better way to handle your cash flow and mitigate certain risks, because you have certain obligations already you need to meet with different providers. You have a payment date, a maturity date. You're not sure if you're going to be able to pay this off early. You're trying to free up enough cash flow because you don't have enough liquidity as it is. You can't liquidate enough because of the banks, community credit unions, perhaps. You're having a lot of difficulty. You're merging accounts. Things are changing in the business. You're trying to get a contract, or you're trying to secure a specific certification and specific equipment and certain things you need to have a down payment for. You need to show the money that it's sitting in the account, that it's sufficient enough. You need to have a good rating with your bank, and you're not having that as it is. So that is one thing. You're lowering your monthly payments. You can reduce them and significantly lower them and put them on a monthly repayment if you don't already have an existing amount that you can right now lower. So that's why people move those over to other type of loan programs. And I didn't mention that much, but we're going to get into the refinancing here in just a second, a little bit more. But that can be reduced in a specific time frame to then refinance and get even double the amount, and then get better interest rates or factor rates in that case, and then increase your term. And that's what I help a lot of people with when they can't consolidate underneath a new loan, like an online bank term loan or an SBA loan. So I just said the rates, the monthly term, having more of, I guess I would say, a streamlined payment, consolidating it and having only one. It helps you keep track of things and not, quote unquote, missing a payment, more or less, because it is stretched out, and it's better for you to afford that. And if you're not depositing consistently, let's say every single day, like those of you who are in retail and restaurants and in other businesses, of course, then you have to look at, when do you deposit? Why have you been depositing that way? Is there a way for you to restructure that with your current debt obligations? That's what I would always think about first. If you have to negotiate or renegotiate certain contracts, you look at suppliers and vendors and other accounts. Can you use merger accounts? Can you look at consolidating something within your business now, reducing expenses on your payroll or anything else with cost of goods sold that are more variable costs that are hurting your business right now, or that ones that are fixed costs that are all induced into your net operating income as opposed to just your gross profit margins in another area. So that's for another time. I look at a lot of businesses and I understand what they need to improve, accelerate, decelerate. So that's another one that I just mentioned, with the monthly payments, the lower interest rates, having more of a streamlined way of looking at things where you're not missing payments. And it could be a better way of saying, hey, I won't default. For a lot of you who have cash advances right now who have helped out debt restructure, reverse debt consolidate, which is the last thing that I would recommend, because that's adding on a new loan payment. I'll get into that in a moment. But it can have a better effect when you do a consolidation for your credit score. And we're going to get into that a little bit more with credit lines and how that can be even helpful. So that's a great way to look at it, is to do a debt consolidation. What many people get wrong, though, is they think that they're going to get their debt reduced or debt reduced completely, when in fact is you're putting it all in one other loan. It's not exactly reducing it, but you're getting everything that you need all in one place, which is still helpful for many people. It's all in one new place, and it's usually the sum of all the amounts that you have currently would be factored into the new amount. If there's additional working capital to add on top of that, what a lot of the things that business owners don't understand is that we're looking at current revenue, we're looking at current cash flow, profitability, depending on the business and depending on also the service, more or less. That's what we look at. But at the end of the day, what you can get yourself into a problem with when you do consolidations is you're not replacing pretty much like your overall debt obligations. If you think about it, you're just extending the term, lowering the repayments. Yeah, that it helps you on a better remittance or amortization schedule. However, if you are going to have longer terms, just understand that the interest rates are going to, or the interest is going to occur. And if you're having a scheduled quarterly look, especially with SBA loans, and those interest rates were to change, now you have added interest than it was before. And if you want to pay something off faster, I always recommend to do that. If you're going to be like, I'm going to make 2.4 million and going from 1 million to 2.4 million in the next 6 months or in the next year, you have to think about what contributes into that. One, two, how are you going to exactly put those funds to use to generate enough ROI, 100 to 200%, 40% margins, 30% increase in margins? Will it be going backwards? Are you going to be over leveraging yourself? Well, once you meet those goals in the next 3 to 6 months to a year plus, whatever it may be, or sooner, then will it stabilize, or will your revenue then drop again? Why? Because you're hiring on more people, you have another expense, you're moving things to a warehouse, or you're having another lease payment, more insurance costs that you just accumulated. You took out more loans for equipment. Now you have 3 pieces of equipment when you should have had 1. So it's understanding how to move up and then go down at the rate that you should. So that's what I wanted to mention off the document. So back to this. That's what I mentioned there. you're moving everything into a new location, a place, using bank term loans, for example, SBA loans. I do a lot of this stuff. If you guys are wondering, not only do I do debt relief programs with many, many ways of doing it, but I do all other things. And people, again, turn to me because I don't push people. I'm an introvert as it is. I don't speak much. I listen. I have everything that I need. I'm in the trenches with the lenders, the underwriters. I don't trust many people on our side. There's a very selective few in this space because you have to be careful of who you work with. And not many people are like giving you what you exactly need longer term. They're giving you what you need short term. They're selling it to you in a way that's like salesy. And I don't even like to use the word sales to begin with, even in the right context. I didn't grow up in that background. Even if it's a good way, it's just not what I like to use the word for. But that's what you want to know about that. I was gonna say U.S. Bank. I mean, that's another direction if you're bank qualified in that case. But there are online bank term loans, is what I should say. They're still bank related, regulated type of loans, FDIC insured, but there are online bank term loan lenders that are willing to have more flexibility in the underwriting process, just about knowing the right ones to go after. And I'll connect you with them. Don't worry about that. And I look at a lot of documents and I package loan applications, loan packages, and I do it correctly. So you don't know, or so you do know, excuse me, that you're not tripping up and doing the wrong thing. And you don't want to be in the unknown that you're only on one leg when you should be on two legs standing up. And a lot of people will overpromise and underdeliver for you. Debt refinancing, that's another concept. It's somewhat like a debt consolidation, but with refinancing, you're refinancing ideally for a better interest rate, yet you're still doing it potentially for a longer term. But the idea is also to navigate being able to make the payments correctly on time, and it'll also increase your terms and get you more funding. So this is a great option to look at, and it's the consolidation is, like I mentioned earlier, it's putting together multiple loans together as one. As in debt refinancing, you're refinancing for a better interest rate. And this is a good example to use for when you're trying to get like cash advances, and potentially you have, this is a whole different subject I can spend hours on, but I'm going to try to keep it surface level. But for example, you have taken out 30,000 of a cash advance, a traditional merchant cash advance or a hybrid cash advance, looking at all revenue coming into the business, albeit you're not over leveraged. It's one position, let's say, for example, or it could be a couple of them with those specific lenders. But let's say you have been given 120 days to make the repayments. We can break that up in the months. We can go even deeper into calculation. I'm not going to get into all that. And the specific lenders and their criteria, they're all different depending on the tiers. And so let's say we were going to give you the ability to pay that off, or say, hey, you're eligible in 60 days for a refinance, or once you're done, you're eligible for a renewal, for example. They can be intertwined, or you can say after you exceeded the maturity date or you've paid it off by that date, you're eligible for a renewal, just depending on when you need to allocate more funds and when you really do need them, and using them for the right purposes, not just for expenses, but overall, over 50% of this should be used for growing and expanding revenue, doubling, tripling, quadrupling gross profit, net profit, understanding how to mitigate expenses in these other areas that a lot of business owners have troubles in, because a lot of the times you're not financially literate. And we're not asking the world that you have to be this, under the microscope of a financially literate person, or like myself, who really understands how to break this stuff down. It's just learning bits and bits of pieces, is how to learn and educate yourself on that. But at a point, look at your business from the outside in and take the time to financially learn these concepts. And this is why I'm here too. And then there's other areas to learn how to do this as well. But 60 days in, you took 30,000, you paid 50% of it off. Ideally, 60 to 120 days equates to 50%. Normally, a lot of the lenders don't want to see 55%. The more you pay, honestly, the more you're going to get in return the next time you try to refinance. And so what happens is, okay, 30,000, the next time around, let's say we can potentially double it. We look at the current month to month bank statements, a month to date, the last 90 days. We'll even look back that time, even with bank verification checks, making sure that there is increasing and not necessarily decreasing revenue. If there's decreasing revenue, of course, we do have to adjust and look at things to make sure everything looks good. But that 30K can be turned into 60K like that. Early payment discounts are there. You look at the cost of funds, what you still have to fulfill on, and things like that. These are things that I can communicate with you in time. but let's say 30K to 60K, or even if it was 45K, even if it were 40K plus, that's a huge advantage than what you've had before. And then with better rates, better terms, that's a great position to get into. Or you can take that existing amount, put it underneath an online bank term loan, a bank term loan lender, an SBA loan lender, and I'll find you the right one. That's what I do. And I look at documents and I know how to underwrite files. So before they go in, and I communicate with my team on the back end. A lot of the things, guys, that I do on my back end, you guys do not see. And a lot of it is confidential. A lot of it is so much to explain. But I'm looking at bank statements, how they get submitted. I'm communicating with my lender here, the underwriting department. And I actually could be a full-time underwriter and or a lender. That's just how my brain works. I'm an analytical minded person and I know how they look at files. But because of flexibility, I have other businesses and the versatility, being a full-time underwriter would take me having to do that 9 to 5 for the most part. Having some flexibility to do it on my own schedule, perhaps, but it wouldn't be as open. And so not every lender will want that and having to do things in-house. But from this point of view, you take the opportunity cost and what you're foregoing to do what you want to do over here. And so being the way that I am, and I'm going to be as helpful as I can to you, the best way to get started is the questionnaire form. I'll get to the comments here, guys, soon, but let me continue through this document. Appreciate you guys. Thank you for continuing and in here with me and being by my side like I have been with you guys. I really do care. I just felt like the rush coming down here because I want to give back to my community. I want to give what you guys were able to earn from your funding, what I'm able to get even a small percentage. I don't look at getting the most points or none of that. I want to be able to feed my family, one, but then two, give back to the community, go out there and give relief to people that don't have a home, people that are fighting to get into a home, people that are in the hospital, people that are doing things that there's so much out there to give that I pay more close attention. And a lot of what I earn here will go for that. A huge percentage of it does. And so you're helping me, and through me, you're able to help others out and in other ways, in ways that you didn't think were even possible. But back to this document, that's just one direction of refinancing. Of course, there are other ways of doing this, but you also have debt settlements and the renegotiation with creditors to sort out paying less than what you currently owe, your current payments, your debt obligations, on what we need to on the business side for a huge majority of this. On your own, you can do this and sort it out if you wish to. Try to take that chance and make the mistake or not. But did you get enough of a reduced percentage? That's what you have to question. If not, could we have reduced 20 to 30% more? It's like saying you can go get a personal loan from a bank that you have a relationship right now, but are they going to give you enough? Do you have enough of a bank rating? Have you deposited enough? Do you have average daily bank balances of this? Do you have a previous track record and history with them? Have you taken out a loan? Have you taken out credit cards in the past? What limits? And so you have to question that. And if you work with the experts, they're willing to give you 10, 20, 30, 40, 50 times the amount of what you would have been able to get on your own and be able to restructure, do all these other parts of the process. But what I would advise, and I've helped out a lot of people do this, and I work with my team, my payment analyst team, people on the other side of things, and what I look at, go over how much can I delegate, how much can I give to, and understand what's happening in those parts of the process, what the calculations are, how they came up with calculations and things like that. But a professional team to negotiate on your behalf, and getting also, when we get into the debt restructure here in a second, an attorney-led debt reconstructing. I always say the word debt reconstructing, but when it is debt restructuring, it's just such a way to say it that it's just, I guess, somewhat more natural. But getting an attorney-led debt restructuring team that has decades of experience that I'm able to partner with and work with, that I've been able to see their work, will renegotiate your existing creditor notes. And this will be obviously the best direction to go into. And I'll get into a little bit more on the debt restructuring side and even the settlement. But down here below, now we get into debt restructuring. And this is the best option for many people. And I'm going to pause here for a quick second before I get into the document. What I want to say about this is this has been the biggest and best option right now, because you have to think about how far back have you been in the debt you're in. Think about your payment history. Think about you've paid things off, you've closed accounts, you have accounts open, your intermediate here is not necessarily open or just yet. You've been applying for a lot of recent credit, and think about it, whether it's you or somebody else, what's your track record? When has that been paid off? When will it be paid off? Can you pay it off early? No, you can't. What happens if you don't pay it off early? What happens if you have a prepayment penalty, or if there is no prepayment penalty? Have you thought about what your business needs right now? Like, if it's such in a tight crunch where you're like, I need at least $200,000, and I'm going to get that if I free up these advances, or if I free up this, but I got to restructure this, or I got to look at it this way. I just don't know what to do. And you can't liquidate everything in inventory, your equipment costs, everything else is going off the roof. Your expenses are even climbing higher than your revenue is. You're sunk into this hole even deeper. You can't even claw your way out of it. You try. All the dirt just keeps rushing into the hole. As fast as you try to get up, at the rate that the dirt is going into, it just brings you down even deeper, suffocating into it, getting yourself into a position where you can't get leverage. You try to move forward, up, down, any direction. You even find yourself bruised up. Heck, you find yourself thinking in negative ways that, like, this is it. No, it isn't. There are ways that don't require it to be debt consolidation. When you can't consolidate a loan, you can't consolidate multiple advances or whatever that is into one, what can you do? Or if you try to consolidate it, you can't because of your existing cash flow. SBA loan lenders, you have online bank term loan lenders. They're going to look at that for lines of credit you try to consolidate with and under. If so, they're going to look at existing cash flow. If you don't have enough debt service coverage ratio, business, personal side as well, operating cash flow, all these other things, well, they're questioning, well, what makes us think that they are responsible for taking on this debt when they couldn't take on that debt before? What led them to taking on the debt that they have or had in the past, if they currently paid some positions off or not, or completely? You have to question that. I question it. I get those answers together. I look at it and I see if it's legitimate or not. I follow up with you even more. Okay, this is what I can take over to my team. This is what I'm going to prepare them for coming into it. Here's what we're going to look at when it comes to the numbers. Here's how it's going to be broken down. Here's my part of that process to break that down, this part. Look at that debt. Look at it this way correctly. Boom. What are you refinancing? What are you not refinancing? Is the refinancing with an SBA loan, online bank term loan, being calculated into the new approval amount? A lot of the times, potentially not, when we're doing that with the new approval amount. And other parts that you are trying to take care of or not refinance and this and that. It just depends on the tier, depends on what we're looking to refinance, what we're not looking to refinance, what we're calculating into our total new debt that we're proposing to give you to cover what you currently have, or have a lump sum of this all in one, and that's what you get and nothing more on top of it, if so. So it just depends on a few instances, but dropping down 40 to 75% of average monthly payments, or I shouldn't say monthly because not every business that is a monthly payment or that you have now or what you will get. But what I mean is you will drop a lot of the times 40 to 75% plus on average of those debt payments that you currently have. So let's go back into this document. And I just want to make sure that that is all there before I go into that any deeper. Let me make sure. Okay. So like I've said here, I have a debt restructuring and settlement team that works with merchant cash advances, MCAs, hybrid cash advances, other debt I'm going to get into in a second. All situations, depending on your needs and what you have and you bring up, are unique, but you may be able to get a customizable plan. Excuse me. And I was thinking about I'll get into this in a second, but where reasonably it's expected to be dropped down by 40 to 75%. And I'm going to get into also reverse debt consolidations and tell you why that's a little bit different when we get into that. But I've seen it drop by that, but this should be here 75% plus, because that's also a possibility to see that. It just depends on what you have, current revenue, what we're going to ask for, if you're not already over leveraged. But a lot of the times this is the best option to then get into a consolidation down the road, to then get into using other options to pay other options down. And that'll free up more cash flow at the end of the day and have better ways of using your money as you need to. To give you an idea of what could be done, I'm going to need you to fill out a debt restructuring application, a business debt schedule. There's going to be some things on the income side that I'm going to need to gather, a few other things we'll get into in a moment. I'll cover a little bit of the details on that in a moment, but let's go through this. To be sure, in almost all instances, we can reduce short-term repayments and get the face value if the MCA debt reduced by more than 25% on average, net of all fees. So that's a great component when it comes to that. And like you see on top of that, the 40% to 75% plus on average is what I've seen a lot of the times that's been able to have customized for each individual client. Not to say it couldn't go over that. A lot of the times who I work with, we have an over 90% approval rate into the program that's specific. Unlike others, you have to be careful of what they can restructure, what they can't. And a lot of the times they'll go behind your back, and be careful on what they do to gather information. So you have to question the source and who you work with. What I would also need, and this goes a little bit more into what I'd gather in terms of documents and what you need to provide, is your contracts you sign usually via DocuSign. That's normally how it happens when you do MCAs or MCA-like debt or other instances. They have a legal lease, so in them that our legal team will use to reverse engineer an escape hatch for you potentially, and that's how it works. Everything that goes on is based upon having that there in stone, and every time they all work 100% of the time. They are successful if you do what you are supposed to do. If you are going around the fence, you're not listing specific debt, maybe something that we're asking for that was supposed to be labeled, we're unsure about, but I need to go and ask you about it because I saw that myself. Okay, this was paid off, or no, that wasn't included. Why wasn't included? Okay, that makes sense to me. So the qualifications when it comes to doing a debt restructure, which is great again, is no minimum FICO score is needed, no collateral is needed. You don't need to look at it from that point of view. Now, when you get into collateral concepts, what you need to understand is I have a lot of people who have commercial real estate investments that they own, investment property, rentals. You can talk about other types. You own things free and clear that you can use to do a cash out refinance before you pay off existing positions and existing debt. So you have to think about, is that my best leverage point? What would I do if I took this money out? How would it be used effectively? Would I be able to pay off enough? Is the amount that I need to pay off enough? Should I even take out that much equity? Like, no, that's way too much just to pay off that debt when I can get a debt restructured and then potentially look at collateralizing and using that, or using a personal loan to get that and help you with that, or also use that as growth and expansion. You have to think about those options. And I'm going to get into the credit lines here. So when you look at these other options, do you or do you not have them? Are they or are they not best to use? Do you have everything tied up into one place? Your credit card processing, your processors? Do you have multiple? Do you have one? You're over leveraged here. Okay, you can't do that option. The consolidation wouldn't work because you're already over leveraged. Cash flow is not sufficient enough. You can't refinance. You're not in due with the refinance situation. You still have too much interest accumulated versus the cash flow that you can't open up and you can't free. So specific lenders would want you to completely wipe off those advances, those processors you're taking advances on, and things like that. So it's always best to get yourself into a position where you have minimal debt. And I know that's harder to do, but specifically when you have higher rates type of products, clearing those off completely, having it reduced really low, having paid off over 50% of that, closer to 75 to 80% plus, having only like one or two positions, one at most or two at most would be best. Don't over leverage yourself with too much. And you have to be cautious and questioning what you're doing and what you will do differently when that does change. So making sure that that is there is of most importance. 30,000 in total debt minimum in merchant cash advances, hybrid cash advance / term loans, and MCA-like debt. For example, other factored loan products like Bluevine, On Deck, Fundbox, Headway, Capital, etc. There are many others, but those are just some of the examples when we're looking at factored like debt that's also on the table. If you have any other business debt, let's say we're not focusing on cash advances, you don't have any cash advances or factored like MCA debt, or you do, and we're going to factor that in, or did you want to factor that in, how you wanted to look at it? You wanted to get this X amount. Your expectation was to get all of it, 40 to 75% plus debt restructured. Okay, that's what you wanted to implement into your restructuring. Okay, that's what you want. That's what we'll take care of. So what we're asking is if you have other business-like debt. So it's credit cards on the business side, bank loans, is it tax liabilities, is it others I'm going to get into in a moment, then the total of that debt would need to be at least $1 million or more for us to be able to restructure it. A lot of the times that is the standard, especially in a market like this. You got to understand your revenue ratio versus what we're restructuring. And a lot of the times when you're consolidating And this is aside from restructuring. When you go back to consolidation, we're looking at what you're holding, what your previous track record, revenue history is like, what it could be in the future. But we're also seeing what is your current revenue, what's your annual gross revenue, how much are you producing. So you took out 2 to 3 loans, you have $500,000 in total, 500,000 in total, but you're generating 500 to 600,000 in yearly annual gross revenue. We're not looking at net profitability. At that point, we wouldn't even have to question that. We'd question it if we have to improve it, of course, to better position you later on for different services and better services at better terms and rates and more. But we look at it and go, 500,000 currently in their debt obligations scattered over 3. Yeah, they have other debts. When we pull up their credit, yeah, like you're already missing payments, or you're close to defaulting on these credit cards, like Chapter 11, Chapter 13, Chapter 7. You're going through different instances, so you have to be cautious of what you're involved with. And if they can't consolidate because of that, you're over leveraged, it's going to make it hard. So what should you do? Well, I can go refinance. It's not going to work either. Consolidation, refinance, it won't be your best thing. You're going to get a new loan. They won't be able to give you a new loan. You're not leveraged enough to do that. So your overall goal is to free up cash flow. What else is it? For more working capital, where is this all being applied to? What do your next 3, 6, 9, 12 plus months look like? What's your ROI on this potential? Okay, it's not ROI. It's not going to increase my profit margins. It's just going to alleviate a little bit of stress because of my expenses. But why is it that way? There's a lot more that I will uncover. And there's more that I'm not questioning right now because there's more questions to cover, of course. So it would be at that amount to restructure it. So keep that in mind. Sometimes we can include business credit card debt in the MCA restructure or restructures, but that will negatively impact your credit. If you are in pain, though, if you're in this like hole where you're like, the last resort, Mike, just take care of it. I don't care if it drops I don't care. Just take care of it. That's obviously your goal, is to make sure your business doesn't go bankrupt, that you don't sell off its assets to recover and do this and be a liability. You're now in the liability column if you were not already. And getting those bankruptcies removed, especially if you're going after credit back programs, even business loans, SBA loans, not over 5 years, even over 10 years, like you've not put yourself into a hole. You're close to defaulting, forget about it. You're going to get if anything, you're going to get a very low amount. That's going to start off between maybe 1,000, 2,500 to 10,000 at most. If anything, it's going to be hard to climb your way up. And that's not what you want to be involved with. So if you're in enough pain, you really shouldn't care about it. At that point, if you're there, I have a lot of people that I've worked with that are there that they just don't care. Hey, Michael, just help me. And I know how to do all this stuff with my team. And so if you want to be in the best of hands, this is the best direction to go into. There is no negative impact to your personal or business credit in many cases, excluding certain factors, as we just went into. So usually that's the case. There is no impact to your personal or business credit negatively in many scenarios. There are no upfront or out-of-pocket fees, unlike if you did a debt restructure or some other situations. You're factoring in fees on the back end. If anybody else is trying to charge you up front or something else, be cautious of that. But there are no upfront no upfront out-of-pocket fees, excuse me. This is a quick and easy application process for you. It's a customized offer, term sheets, closing call within 24 hours for the most part. Here are the other types of debt that we can restructure. It's determined on a case-by-case basis. Government loans, vendor debt, supplier debt, commercial real estate debt, term loans, lines of credits, all forms of tax debt, tax liabilities, debt from business ventures, depending on what those ventures are, business credit cards, that's an obvious one, bank debt, credit union business debt, non-bank business debt, equipment loans, any unsecured business debt, any secured business debt. It goes both ways. Whatever you're pledging, whatever you turn secured to unsecured on the business side, it's a pretty good way to look at things and say you have as much flexibility as you can. And so I have another screen opened on my side that it's a confidential side for a lot of different clients that I've helped out with debt restructuring. So I can't show you the exact parameters on that, but I can go over what I have here. So let me move this over. And so just so you know, there are instances where recently I've helped out people with 500,000, 300,000, 400,000, even less than that, closer to 50, 40,000 in just MCA debt, or added to other type of business debt that people have been trying to debt restructure. but the payments can be very flexible. You can have like a 35-week repayment schedule. That's one example, and it can drop your payment significantly. You can save over 100,000, over 200,000, depending on the amount that we were able to restructure, the percentage on the average there, and when your first payment, or how soon can you pay this if you decided to, instead of the expected first payment date. There are a few things that we can go over, but that's more or less what I wanted to cover on that aspect of that equation. So let me come back into this part here, and let's go into, actually, I'm going to go into this. Here. I have this on my other screen. Again, this is confidential stuff. So let me back up. And again, all information to get started, if you haven't already, is with the questionnaire form down below. And if you have and I've yet to get back to you, I will in time. I apologize if I haven't yet. I do get quite busy, and that's fine. You're working with an expert. At the end of the day, you want somebody who is very loyal, trustworthy, reliable. You have that person right here who is willing to help you. I'm all for it. I'm all ears. I never push anybody. I never think that I'm better than anybody. I never let things get to my head. I just didn't grow up that way. And so again, I give back and I do things in a way that's very effective. So like I said earlier, the types of documents that I'll require, but I'm going to need a copy of all signed funding agreements. I'm not going to get into all the details on what we're doing there, how to look it up, but just know that I need that. And I'm going to ask it from you in time. And what would be expected, I'm going to give you some fine details: business bank statements, most recent month and month to date, copy of front and back of your valid driver's license. Of course, it has to be valid. Once these are connected with, myself and my team will review and then get back to you. And just remember that over 90% of the time, people get approved for this. So I'll give you more details on what to do, how to locate them, what not to do when you're trying to get your contracts and sent over to me by not asking your providers, and understanding that the customer service personnel is there for the attendee is up and specifically trained for them to locate these things and calling you and doing things. So you have to do it in a way that is done correctly. And I can give you more details on that, of course. But I'm going to move into the next topic here. I think I covered everything that I need to on that end in terms of certain documents. Debt restructuring Excel sheet that I'm going to send to you, income projection, and I'll give you the details and go over that with you in time. So the next part here is going to be a reverse debt consolidation. And this is the last option. This is the one where I'm going to give you a yikes here, because this is just going to give you a new loan. The debt restructure, we did not give you a new loan. As I said, there are no new loans for this. And that's a huge advantage. Why? Because we're not giving you a new loan, and we're saying, hey, you have to also pay us that loan on top of everything else you have. We're saying we're going to restructure 40 to 75% plus on average. Yeah, you might still have those obligations to those current MCA providers, one or so, but it's reduced and it's increasing your cash flow. That's what it should be doing. To what percentage and to what extent, and then what you're going to do with that and what you could do to help you with other parts of your business, that's a whole nother topic. But think about that. You're not getting on a new loan payment with a reverse debt consolidation. Yeah, you're going to get one that exceeds it. It can exceed it by 20,000. So I'm going to give you an example here. And again, this is off screen. This is confidential from a specific file, but I'm going to go into some of the parameters and help illustrate the point. And so just understand that you're getting a new loan to service the existing total amount of debt service you have to cover over the existing terms in the existing year, or however much time you have. And the amount you may be given for that new loan to pay it back in total could be 4 to 12 plus months, or more or less 15 months, but it's shorter. So think about that. And now you have a new loan. You're like, oh, dang, now I have to go and meet other debt obligations. And you're finding yourself in this whole reverse debt consolidation that is now taking a piece out, even if it is a reduced somewhat of a payment. Now you find yourself in a situation where you're thinking, yeah, my payments were smaller. Your cash flow may have increased. Sure, it'll buy you time, but will you then default? It could have bought you time now where you won't default, or you won't miss a payment. You won't bounce checks here and have overdrafts and all this other stuff that you can't meet and pay your certain providers. But it's just a meantime thing. So if you're going to be defaulting soon, what worth is that? Think about it. And that's going to be tying up your cash flow, and you can't pay that off. Now you have a bigger amount that you have to pay off. You're like, I don't even have a collateralized loan or a personal loan that can help me alleviate this pain. My utilization is so high. I have nothing in credit cards that will allow me to help me pay this or do things in other ways where I can liquidate the cash out of this, have enough liquidity cash on hand. You have to think about all these other options. And then you find yourself with legal issues. Now you have to go speak with an attorney. Now you have to go speak in court. You have to be very careful about it. So the amount of debt you owe now is going to then increase. That's the end of the day thing, and you'll still be obligated to pay those MCA providers, albeit that it dropped. But now you have a weekly payment on top of that, those daily or already existing weekly payments. You're going to be staying in debt a lot longer. Your fees are going to be high. Sometimes it's no fees, depending on the amount that is reverse debt consolidated, but it could increase. And that's also another thing that you have to look at on the surface. So going into this a little bit more, let me move this here. Let me explain it word per word as I put here in my own words, and also what you need to know about when it comes into a reverse debt consolidation. It is where the funder will provide you, or the service or provider, funder, lender, you can say that in different ways depending on the institution, how they operate, with a loan that's in exchange for taking on the daily or weekly repayments that you are enduring currently from that merchant cash advance or advances. And then by doing this, the business, or your business in this case, is then granted an extension on your repayment term. So your business will pay back the reverse consolidation financier, the person you owe the money to, a portion of what it was paying the cash advance lender, but now for a longer amount of time. So you're going to not only be you're going to be getting paid down on those advances, but you also owe the service provider who was able to help you reverse debt consolidate. And that can be for a longer time. It usually could be for a shorter time though. By extending the loan repayment term, the reverse consolidation lender then provides your business with more breathing room. As I mentioned, some of the positives to it, you're increasing cash flow, or you're at least stabilizing it. This is especially useful if your cash flow is tight or credit sales aren't performing as well as expected. The way you already deposit, if you're lowering your revenue, that's also a big issue. If you're finding yourself into financial difficulties where your revenue isn't where it should be, you're losing customers, you're losing sales, you can't produce the results you were producing or thought you would have, hypothetical projection, cash flow and assumptions, X amount of customers per day, you generate X amount of results, you lost people in the business, it's a high overhead business, you have to be cautious of those things. So now you find yourself in a situation where you're in a lot more problems. But that's where also the issue is, because you then have to owe that provider. If your revenue isn't producing, heck, you lose out on certain deals, equipment. Now you have that other loan you got to pay. And if you don't pay it back, you can find yourself in a bad place, not only with your current debt, your providers, MCA providers, that if you have more than one, that's a whole heap of trouble. And then now you have another one. But there's a time and a place for this. If it's your absolute last thing to do, that's what I would recommend. And even if it weren't, it could be a good solution for the right person. So it just has to make sense. You have to understand your numbers and really make sense of what you can and can't do. Otherwise, you're just going to be in a bad place. So by taking out a reverse consolidation loan, it can typically lower payments by 40 to 60%. It could be lower than that. It could be 20% to 60% plus that I've seen. I've seen one with 25%. I've seen one with 35%, 40% and above. This means there's higher net cash within your business because of the lower payments. That's typically expected. It's also a good way for you to consolidate your multiple cash advances. So this would be a good solution if you had, I would always say one enough. I wouldn't even say if you have over 100,000, your revenue isn't where it needs to be. You're already over leveraged what you're holding. Average daily bank balances are too low to be doing any of this. It won't really be as helpful. And that's a purpose for it to increase your cash flow and average daily bank balances. But at times with your revenue and other instances, you have too much that we are trying to reverse debt consolidation. It'll put you even in a deeper hole. You have over 300,000. You want to reverse debt consolidate, only doing 300,000 a year. And this is what it breaks up to month revenue. This is the trending. This is the balances. Like, whoa, no way we can do that. You're just going to be having a new loan. You won't meet those obligations. You can't already meet the current obligations. Even if we lower the amount, it'll still be a lot harder to do. So there is that. part of it. It's also a good way to consolidate them. As I said, the easiest way to think of a reverse consolidation or debt consolidation on a merchant cash advance is that it turns the loan into a larger loan with a longer repayment period with small repayment amounts. I know there's a lot of words being thrown there, but that's a good way to look at it. It's a good option, as I mentioned, but the last one I would recommend usually is it could impact credit. But if it's the last resort and you really needed it, then there it is. As I mentioned, the benefits of it: smaller payments, cash flow can increase, gets you out of a debt, out of a default in a shorter time. Like it could be a temporary Band-Aid. I don't see it being a longer term Band-Aid, so be careful of that. And harder debt options. If you have other ones that you just absolutely need to do it, it can be something temporarily. Negatives: your own debt increases. You don't reduce the amount you owe. It still increases your overall debt flow and your load. You're still, excuse me, introvert problem there. Like, on video for a little bit. And so that happens. You're still expected to pay your current MCA providers their payments and weekly payments to the reverse debt consolidation provider lender. And going back up, it increases your overall debt flow and load. I wanted to reemphasize that. That's going to be a big difficulty when it comes to paying your current providers. If you're already in a bad position, that won't do you any good. You could end up in a lawsuit if you can't make the payments. As I mentioned, you're in debt much longer. You get a new loan with longer repayment terms or term than what you currently have with your MCA or MCAs. You will have payments to take on after your MCA payments are done. Higher fees could be added. A lot of the times there might not be any fees, but that's something that you would endure. And if this is something of an option and you want to go over it, then get started in the questionnaire form. And if you have, I'll communicate for more of it with you. But I have an example here that I want to bring up that it's something I can't display right now on the screen because it is confidential for a specific client. It can't be used on screen as an example. But this is what I've done, and I've helped out a lot of people with, and I could pull from a lot of different ones. But here, just want to make sure this is there. Yes. Okay. So there was one example where I won't say the name of the company. I won't say the name of the merchant or the funding date. I won't give all of that. But let's just say, for example, Joe here, and Joe's bakery shop, for example, had an existing balance when we calculated and we put together. It's very simple to look at all the advances, their current amount that they still owe, and the principal interest on top of that, and what we look at over a remittance schedule when we give them the reverse debt consolidation loan. But let's say they have 60,000. Let's just average it out to the 60K plus. And so at the moment, depending on how their payments are, being ACH, wired, however it is, or when they're paying, what day more than anything. Is it weekly, daily? It's for the most part with cash advances. So let's say daily, they have 2 advances and their total is, let's just say $800. Of course, it's not always that accurate when it comes to it. There's usually a 1/10 to a 10th decimal that we do, a percentage, or we do an amount like $800.55 or $750, $749.25, for example. So what would be the new daily payment? Will we look at, okay, well, we can reduce a percentage of this amount. All right, we'll bring it down to $500. So let's just say approximately $300 there. We can put it into a percentage if we want to do and get into that. Let's just say on savings, I'm just going to throw a rough estimate up there of 30 to 40%. So let's just say that would be the case. Or let's just say closer to $800 to $500, $300 difference. Probably do 30 to 40. We'll keep it at that percentage just for this example. I don't want to get too specifically on the savings percentage. But let's just say it's at that. All right, we have everything else considered. What's our offer that we're giving that we're able to pay off weekly? How much are we paying off? How much do you net for this? And a few other instances that we look at, which is the right to receive. And when we talk about right to receive, and if you were to see that, it's the purchased amount in the MCA. It's how much outstanding purchase amount you still have to owe to the provider. And as you pay off, for example, 60,000, then becomes 40,000, your RTR now becomes 40,000. And then we break that up how it looks like week per week and what we're giving you to pay that down. So that's just another way to look at that. And it'll fluctuate. It'll go up and down depending on how you make or when you make your payments. And you'll see that a lot of the time. So that's one part. The number of withdrawals will give you an estimated amount of time. So that can be 120, 160. It can be the amount that is distributed based on your file. So we give you a distribution amount, and what we're saying over week per week over the allotted time, which let's say we're giving you 15 weeks to pay that off. So we're going to give you a weekly deposit of, let's say, roughly getting up to 4,000 it's not normally going to be like a 4 or 5K, 6K. You could see that, but you may see something like 3,452, 3,399.21 or something like that. And so we're going to be able to see how much you owe per week. And I can do some calculations. There's more calculations I do on my back end too with this. And over week per week, it's consistent to cover those loan payments that you have. But then you still owe the provider with the new loan. So you're seeing what you're paying and what you're having to pay the provider. And so maybe as you get closer to the 15th week or however much time it is there, then you look at it and go, oh, well, now I only pay 2,000 as opposed to 3,000, or 4,000 you were paying, now you're paying 3,000, or 4,000 now 3,500, because you're making those payments. And if we offload the payments more on the front end and then offload them less on the back end and do less, that's another thing. And that's what you'll see with some of this. But the amount that you get per week just depends, but it is sometimes considered more of a shorter term in the expectation and the repayment, especially with what the provider gives you to help you pay those things down. But that's what it is. There could be 0% fees at funding, and it could be slightly higher than that as well. But that's just a quick example that I wanted to get into. There's more that I can dig up into that, but I'm going to just leave it there for now. I want to make sure that I did cover everything. So let's see, I covered the debt restructuring, the debt consolidation, the refinance, the debt restructure, the reverse debt consolidation with the on the other side being then the debt restructuring program, and what are the advantages to more or less all of them in a specific way, what you would have to look at, what you can reduce, what would then be increased, what you do need to pay close attention to if something were to fluctuate. But I think that is everything. Let me make sure everything in my notes here are the way that they should be. Yeah, and there's more that I can cover on each one of these, and it's specific to your file. So when everybody asks me like, what's this? Without me digging up more about your credit, without me digging up more about the revenue and this and your circumstances, I can't just give everybody the same answer. So you got to see that more or less, that business debt consolidation, refinance, the debt restructuring option, which is strong and the one that I recommend, dropping those payments, 90% approval rate, 40 to 75% plus on average, dropping debt payments, and also using other forms of funding after that strategically and moving up and increasing your cash flow to then qualify for online bank term loans, SBA loans, have better options. The refinancing, when you have cash advances for another cash advance or another lender as you move up in revenue, there are those instances as well. And what are the requirements there? Reverse debt consolidation, how it's good and how it could not be. Just make sure you use it correctly. And then there are other forms out there that we can use other debt to pay out or pay off other debt, buy out other debt. And so just so you know, of course, these are usually the most known options, and we can use collateral, we can use other things to pay off other things and buy out other things to do this underneath this option. But you got to see that more or less. So in the comments, welcome in. Sorry that I didn't get to you guys earlier. I really wanted to cover, there's a lot to cover in this video. And again, I can get even more specific per case basis. For what type? Debt restructuring, consolidation. I'm not sure if you're still, I know a lot of you are not in here after a long time. And this was a spontaneous live, by the way. When I broadcast it, it's different. But if you can't make it, I understand. If you're on the replay, great. Appreciate you too. Thank you very much. You're no different than anybody else. And so I'm very appreciative and thankful whenever you can watch this, whether it is the replay, a lot of people can't make it, or you're here on the live. Yes, Mary, that's an option. And as you've heard me say, that we can look at refinancing, but again, it's per case basis. What you have to be cautious of too is sometimes we can refinance like cash advances if you took less and the rates weren't as high and you had enough cash flow to service that and help refinance that underneath a new option. But when you don't have enough cash flow, your cash flow is stuck up in other areas, and you are trying to find debt relief at the same time, trying to get an SBA loan, 10 years terms. And it's like, you got to be cautious. And if an SBA loan option is only going to approve already 30% of your top line revenue, or 10 to 30% more or less, without collateralizing, or if you added collateral on it, could it still be between that more or less? Like, we have to look at a few things and making sure you're not over leveraged, making sure you can sufficiently pay the existing debt that you have. And if those options don't work, I always recommend a debt restructure. I'm doing that a lot with people, and that can then turn into something later on where then you try to refinance things, certain options, put it underneath an online bank term loan, an SBA loan lender, and you maximize the potential there. Do that all the time. And I know my way in and out from a lot of this and doing it ethically. So I think that's where I want to leave it at. All of this information for getting started is in the questionnaire form down below. Let me show you how this actually looks, and then we'll close up. Stomach rumbling. I had breakfast earlier. It still does that. So on your screen, this may look familiar. If you filled this out, be patient with me, or if you know what I'm going to get into, you don't have to stick around. That's fine. But here it says, get the funding your business needs fast with the help from a real expert. Like I said, I'm a business funding expert, business loan broker expert, pre-underwriter, underwriter. I'm able to look at documents and understand and evaluate. A lot of people can show you how to get funds. Now, how well they do it, that's another question. But how many of them know how to help improve your business? How many of them know that you should allocate the funds this percentage here? This would help you this based on your current trajectory, doing it this way. A lot of people can tell you, hey, go get this funding for real estate. And I also help out a lot of real estate investors, in case you're wondering. So, one thing I did want to mention before any of this is, where does the credit line up with all this? Credit lines, 0% interest business credit cards. For a lot of you trying to get personal credit cards, business credit cards, personal term installment loans, personal lines of credit, HELOCs, all of the stuff that has to do with credit, creative credit-based financing. What this allows you to do by restructuring is opening up your cash flow. If this also affects your credit in a positive manner, where you're able to then take other money and pay down utilization, get yourself into a better position with your credit history and take better advantage of other products and services, that's going to be the optimum thing to do. And you're optimizing your personal credit while you're also restructuring, or you're optimizing your personal credit after you restructure or in the meantime. And so doing that, it brings up your credit score. It allows you that freedom, that breathing room. Now you're not stuck up in all these payments, or you're letting these payments roll over when you should have been paying them off earlier, and doing other things to make sure you do it correctly, not extending your credit incorrectly, getting too many inquiries and doing it incorrectly on that side. But then now we get into a credit line program where we can do multiple business credit cards at 0% interest for 6 to 18 plus months. It just depends on the provider. What bank you go to, regional, lower tier, community credit union, what do we turn to? And if you want to have more of a done for you setup, I can do this with myself and or with my team. And it's as helpful in helping you get the max approvals. And I'll go into everything. And if I haven't already done that, the best place to begin with is this questionnaire, so you can get an understanding of a lot of this. And that's how people move into these things and free up that space, increase their credit, or use a credit partner to get this on the business side, on the personal credit side. So there's that. Now let me go over here. How are you, Mel? Great question. And I appreciate you asking this. Just so you know, Mel, for full transparency, I'm always transparent with everybody. I help out a lot of people when it comes to real estate backed loans, whether it's traditional real estate financing, you're doing hard money, you're doing it in various formats, or in this circumstance with the condo. I'm going to gather more details, of course, and we're not going to get into it, all of it here. We're at the end of the video, but I would ask you a lot of more specific questions pertaining to that condo, because it is a condo. But if you have that and you own it and it's all free and clear the way you have it, and it looks good, everything is there, we can inject, we can pull out equity from, we can do these certain instances, or we can do a sell lease back. What I would recommend, if the revenue isn't there, because there are lenders who will collateralize real estate, if you have commercial real estate more so, and if you have, it's not like this whole other type of passive investment, or it's a primary residence, that's different. You might want to go work with a mortgage company or in a specific different format on that side of things. Other loan officers that can help out with that and do a cash out refinance on that side. It's a little bit different. But what this would do, I think the best scenario, after I look at the details, if the revenue isn't in the business, A lot of the times they want higher revenue, they want more stipulations and these things, is to do a cash out refinance. And if you want to work with the best in that, you want to have the best option, be looked at for the best option. I work with the best lenders in this space, the best people to help you on that. I'm in the trenches with them every single day, meetings, things like that. And I connect with them via email, look over files with them. And you want the best. And I've done this various times, is we can go in that direction. Or a sell leaseback, they hold on to the title until you pay the full amount. And that's the second option as opposed to the cash out refinance. And I'll look at the details to see what would be a better term, what could be the obligations with this, what potential fees associated. But when you have a term sheet and when you have the information that I'll relay back to you, then you'll have it. And so what I recommend, if you would like to, is also send me an email. And for everybody else in here, I'll put my email in the comments. Give me 1 second. Add it in caps locks. I have the might not show correctly. Oh, it did. I have the ring lighting on my HP. Anybody with an HP, to enhance the lighting. Sometimes it still goes dark. It fades in and out. So I didn't think that I put the last few letters on correctly, or before. IONS, ions, chemistry. And so that's my introverted geek side. I like chemistry. I study chemistry and other topics and for other parts. But anyways, that's a whole another topic for another time. And so that's there, my email address. Feel free to reach out to me, Mel, and I'll help you out. I have a lot of people who bring that up to me in my email inbox, and I work with them in my email inbox a lot. People right now with condos, people with apartment complexes there, convertible things, people with hotels, commercial real estate, SFR, single family residentials, all with a combination on a lot of these things. Many other instances that I can work with. You are most welcome. Appreciate you. Thank you. And I'll be looking out for it. So going back here, I'm going to close up in the next minute. I'm going to run through this quickly. If you've seen this, you know what this is, of course, but you can select from one of the two options, scroll down. You can see how it'll work, more or less. Some of the results that I've generated. Of course, there are many, many more. I only put a handful of them here, but you can see that there. And you go up here, select from one of the two. Startup, you can select there, the details. That might change the form a little bit, but here it is. If you go to non-startup, it's backspace. There it is. Could look different more or less over time. But here it is. You want to read this first. It's very important that you do that. I won't go over that with you, but fill out some simple details. Shouldn't take you any longer than a minute. Literally, it can give me some rough estimates, excuse me. Just be as accurate as you can be. But when you have that here, you just input it. You go to my thank you page. Normally, there will be a video or other types of content on there if it's changed. And it might be me introducing myself to you just so you know about myself a little bit, and or just go into what parts of the process would then look like after that. So here it is, more or less. And from there, you can get started. So here, let me move this over. Okay, now that will conclude everything. Appreciate you guys. Thank you for tuning in and asking questions. I'm an introvert, so when I go into rooms, I don't normally ask questions. I'm like the observer type, that when I do ask a question, it's like, it's almost rare, but when I ask it, you know, it's for like, it's something good. And I'm unsure about it, or I just needed clarification on something. But like many of you, I have these questions in mind. I had them when I first got started. People tripping me up, the way they spoke. I'm like, I'm not judging you, but I just don't want to I don't want to tell them I don't want to work with you. Like, I don't want to be like that direct. You can be, and I can be direct when I have to be. It just has to make sense. But there are people out there who you don't want to work with, and you go, well, they're a bigger corporation. And think about this at the end of the day. If that corporation has like 50 people, or they're like a big company running 50,000 per month in ads, so what? Does that mean they have what's best? No. In terms of lenders, in terms of the business, I know. I've seen that a lot of the time. Does it mean they have your best interest at heart as a person? Normally not. I'm being very honest with you. They may try to spew things into you, but hey, I'm working for my company. I can't say this. I can't show that. But when you work with somebody independent and you're also helping out a small business owner who really cares about you and your success, think about that. If somebody would have come to me with that and I know more about them and what they can provide for me, I'm going to go help out that small business. I can rest assured at night, like, I'm not going to go help out big pharma. I'm going to go help out them right here who are situated, who know their stuff, who have a higher mission and a higher cause. That's not just funding related. That's the person that I want to work with. All right, everybody. Appreciate you all for tuning in. Thank you again. If you haven't subscribed, please go ahead and do so. Click that bell notification icon so you do not miss any future content I will be coming out with. And if you did get value from it, please give it a thumbs up and share it with others who you feel will find value from it. I think I have covered everything. Let me go over through my tab here just to make sure. Okay, that was covered. Oh yeah, and another thing that the SBA I did mention, it just depends on the type of an SBA loan. Like an express loan up to 500,000, up to 350, up to 150. Just depends on the amount and the lender. That's another situation, but there are higher SBA 7A loan products as well, and other instances where it could be an online bank term loan to then refinance that debt underneath an SBA loan, consolidate things and do things there. Okay, so that'll be everything from me. Appreciate you. Thank you for tuning in. All information will be down below in the description. Get started with the questionnaire form if you haven't, and if you have, I will get back to you in time. Appreciate you. Thank you.